In this part, I'm introducing the property, plant, and equipment disposition. Because most property, plant, and equipment assets have limited useful life, so a firm will retire their plant assets when it is close to the maximum useful life of the asset, or dispose of the assets by sales, exchange with other firms, or involuntary conversion or abandonment. No matter voluntary or involuntary disposal, first of all, the firm should update the depreciation to date. Since the depreciation is an adjusting journal entry, so both depreciation and the accumulated depreciation are updated periodically. Before we recognize the disposition of PPE, we first should update depreciation and the accumulated depreciation. Let me just use several examples to illustrate the procedures. In this example, it is sale of plant assets. We have the cost of the assets, $18,000. It has been used for 9 years. Each year, the firm recognizes $1,200 depreciation expense. The firm planned to sell the machine in the middle of the 10th year. The price is $7,000. Because this transaction takes place in the middle of 10th years, the last depreciation recognition is by the end of the 9th year. We first recognize the half-year depreciation. The half-year depreciation is $1,200. This is annual divided by 2, so it's $600. The journal entry to recognize the half-year depreciation is debit depreciation expense $600 and credit the accumulate depreciation. Before this journal entry, we know in the balance sheet, this machine is reported as the cost $18,000, and less the accumulate depreciation, which is the 1,200 multiplied 9. So this is same as 18,000 subtract 10,800. So net book value is 7,200. But we know that's the book value by the end of the 9th year. After this adjustment, the book value of the machine will be 18 subtract 10,800 plus 600, because accumulated depreciation increased 600. So that will be 11,400. So the net book value will be 6,600. Only when we have the book value up to date, then we can make the journal entry of the sales. As we know, the market value of this machine by the time it was sold was $7,000. This is also the amount the seller, the company, receives. So we debit cash 7,000. We know the book value of this machine is cost 18 and accumulated depreciation up to date is 11,400. So we credit the machine and debit accumulated depreciation. We write off the asset from the book. The net book value is 6,600. The fair value is 7,000. The difference is $400, and it is a gain. We credit gains. I assume the fair value is 6,000, because 6,000 is less than the net book value, 6,600. So that will be negative 600. This will be a loss. The journal entry should be with debit loss 600, debit cash 6,000, debit accumulated depreciation 11,400, and credit the machine 18,000. For some other involuntary conversion, the journal entry is similar to the sales. The involuntary conversion includes fire, flood, theft, or contamination. Again, the company should report the difference between the amount recovered and the book value. So the amount recovered is considered the fair value. In this example, this firm received $500,000 from the insurance company. The net book value is $200,000. So the $200,000 is the difference between cost $400 and the accumulated depreciation $200,000. So the journal entry is we first debit cash, which is the fair value, the price. To write off these assets by debit accumulated depreciation $200 and credit plant $400. Because the fair value $500 is greater than the $200,000 book value, so the $300,000 is gain. So we credit gain $300,000.